You're going to have 15 seconds to answer those questions. And I want to know in the comment section below how many you actually got right. And I want you to be honest about it. What financial statement reflects a company's net income? A, income statement. B, balance sheet. C, cash flow statement. D, statement of assets. The correct answer is A, income statement. The income statement will reflect an entity's revenue and expenses and ultimately its net income. This is your P&L. This is your profit and loss. Question number 2. If you debit an asset, it will increase the asset. B, decrease the asset. C, result in a zero balance. Or D, convert to a liability. Answer is A. It will increase the asset. The natural sign of an asset is a debit balance. So if you debit an asset, you are effectively increasing that asset. You can think about your own checking account. If you make a deposit into your checking account, you're effectively increasing your checking account. That is the same concept of debiting an asset. You are increasing the asset. You are depositing more value into that asset account. A liability's natural sign, its natural balance is A, debit, B, credit, C, neutral, D, credit. The answer is B. It's a credit balance. The natural sign of a liability is a credit balance. So if you credit a liability account, you are increasing the liability's balance. For example, if you add an invoice to your accounting system, you would credit accounts payable, which would increase the accounts payable balance. Which one of these assets is generally classified as a current asset? A, fixed assets. B, intangible assets. C, cash. D, land. The answer is C, cash. Cash is the most liquid asset on a balance sheet and will be classified as a current asset. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. Let's continue going over our Accounting 101 quiz. Question number 5. How long is land depreciated for? A, 35 years. B, 40 years. C, you got to look at the appraisal. And D, you don't depreciate land. The answer is D. You do not depreciate land. Land is land. GAAP does not allow you to depreciate land because the idea is land's always going to be there. There really isn't a useful life. You just keep it at historical cost on your balance sheet. Question number 6. A prepaid expense such as prepaid software or prepaid insurance will be classified as A, an expense, B, an asset, C, a liability, D, stockholders' equity. answer is B, an asset. Prepaid expenses are generally classified as current assets on the balance sheet since prepaid expenses have a future economic value beyond the balance sheet date. You're going to be taking those prepaid expenses and eventually rolling them onto your income statement. Question number 7. Retained earnings are A, accumulated net income less dividends, B, shares of stock issued, C, dividends paid, D, additional paid in capital. The answer is A, accumulated net income less dividends. Retained earnings is the accumulation of net income from your income statement over an entity's life, less any dividends that have been paid. It's the accumulation of your P&L's net income, less anything that's been paid out to shareholders. Question number 8. Accounts payable represents A, invoices received but not paid, B, paid invoices, C, checks cut for expenses, D, unpaid revenue. The answer is A, invoices received but not paid. Accounts payable represent invoices. These are expenses which you have received. You've incurred those expenses, but you have not yet paid them. You've entered them into your accounting software, but you have not cut the check or made the payment to the vendor. If Achilles Enterprises generates $1 million of revenue from sales and $10,000 of interest income and has $310,000 of operating expenses, what is the net income of Achilles Enterprises? The answer is C, $700,000. We're going to mock up an income statement here in the answer. You have $1 million of revenue. You have $10,000 of interest income. So your total revenue is $1,010,000. $310,000 of operating expenses. You take your revenue less your operating expenses, and you end up with $700,000 of net income. Our last question, question 10. If Odysseus Inc. has $2 million of assets and $500,000 of liabilities, how much is stockholders' equity? A, $2.5 million, B, $500,000, C, $2 million, D, $1.5 million. The answer is D, $1.5 million. Now, our equation for a balance sheet is assets equals liabilities plus stockholders' equity. So if we know what our assets are of $2 million and our liabilities are of $500,000, we know the $2 million less the $500,000 is going to get me $1.5 million of stockholders' equity. And when I add the liability plus the stockholders' equity together, I get $2 million, which balances with my $2 million of assets. What describes the estimated value of an asset at a specific point in time based on an assumed interest rate or rate of inflation? A, present value, B, future value, C, compound annual growth rate, D, net present value. The answer is B, future value. Now, this is the time value of money. The future value is an estimated value of an asset at a specific date based on an assumed interest rate or inflation rate. Basically, you're going to take a set rate over a period of time, and you're going to have your starting value, and you're going to use the formula below to calculate what that future value will be based upon your inputs. Question number 2, what is stock dilution? A company redeems shares, lowering shares outstanding. B, a company increases shares issued and outstanding. C, a company issues 10-year bonds. D, a company redeems zero coupon bonds. The answer is B. The company increases shares issued and outstanding. When a company issues more shares and a current shareholder does not buy, receive a pro rata portion of the shares issued, that shareholder's ownership will be diluted since there are more shares issued and outstanding. In other words, the denominator of the ownership equation has increased while the numerator remains the same. Question number 3. Compound annual growth rate, CAGR, measures A, average diluted earnings per share, B, investments average annual growth rate, C, average stock price per year, D, average cost of debt and equity financing. The answer is E, investments average annual growth rate. CAGR measures an investment's annual growth rate over the time, which factors the effects of compounding. Basically, you are looking at the return on investment for a particular asset, and what CAGR is going to do is smooth out the average rate of return for each year. Question number 4, how do you calculate dividend yield? A, dividend per share divided by share price. B, dividend per share times share price. C, dividend per share times earnings per share. D, share price divided by dividend per share. The answer is A, dividend per share divided by share price. Dividend yield is the dividend per share that you're receiving divided by the share price expressed as a percent. This is a similar idea, similar concept to interest, the interest rate on a bond expressed as a percent. Question number 5, how do you calculate earnings per share, EPS? A, EBITDA divided by weighted average shares outstanding. B, weighted average shares outstanding divided by net income. C, net income divided by weighted average shares issued. Or D, net income minus preferred dividends divided by weighted average shares outstanding. D, you're going to take your net income from the P&L and you're going to subtract out any preferred dividends and you're going to divide that by weighted average shares outstanding. That is going to give you earnings per share, and that is a big driver of stock prices. You want to see earnings per share going up. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. All right, question number 6. What is the strike price on a stock option? A, fair market value of the stock. B, price the option allows you to buy the stock at. C, price of the stock when it's out of the money. Or D, price of the stock in 10 years. Answer is B, the price the option allows you to buy the stock at. A stock option will have a strike price, and that strike price is going to be the price you can go and say, I want to buy shares, and I have this option. I can buy them at X dollars. So you might get a strike price of $10, and the stock price has gone to 30. You then can exercise those options, buying at 10, and you have a $20 built-in gain when you're buying your shares because you have a strike price at $10. Question number 7. What is a reason a company would buy back its own shares of stock? A, to increase liquidity. B, to lower tax liability. C, to finance a new acquisition. Or D, the increase earnings per share or other financial metrics. The answer is D, to increase earnings per share or other financial metrics. When a company buys its own shares back, it's reducing the total number of shares outstanding in the company. If there are less shares outstanding, metrics like earnings per share will go up, because earnings per share, you're taking the net income less your preferred dividends divided by the average shares outstanding. So if there's less average shares outstanding, a lower denominator, you're going to have a higher earnings per share number. Question number 8. Which one of these is not a liquidity ratio? A, current ratio. B, quick ratio. C, cash ratio. D, inventory turnover ratio. The answer is D, the inventory turnover ratio. That is not a liquidity ratio. That is an asset management ratio. Current, quick, and cash, that is going to be looking at your current assets and how much cash and how much current liabilities you have on your balance sheet. Those are going to be your liquidity ratios. Question number 9. What is a financial statement projection? A, financial statement that agrees to your tax return. B, a cash position of a prior year. C, prospective financial statements based on assumptions. Or D, historical financial statement. The answer is C, a prospective financial statement based on assumptions. Projections are financial statements where you have historical information and then you're going to layer in future assumptions to get an estimate of what you think your projected results will look like. You're in May and you want to know what your year-end, your December 31st financials are going to look like. Take your year-to-date results through May, and then you're going to layer in assumptions, idea of what your projected financials are going to look like. Question number 10. Interest rate risk describes the risk that A, a value of a bond will decline due to interest rates. B, a value of a bond will decline due to inflation. C, a value of a bond will decline due to bad debts. Or D, a value of a bond will fluctuate with the stock market. The answer is A. A value of a bond will decline due to interest rates. Interest rate risk is the probability of a decline in value of an asset resulting from an unexpected fluctuation in interest rates. Question number 1. What describes the amount of goods and services that people are willing to buy at a specified price at a point in time? A, quantity supplied. B, quantity demanded. C, discounts. D, surplus. The answer is B, quantity demanded. Quantity demanded is the amount of goods and services that people are willing to buy at a specified price at a point in time. Question number 2. What market structure describes a small number of companies that compete in the market and have significant control influence over that market? A, monopoly, B, oligopoly, C, monopolistic competition, D, perfect competition. The answer is B, oligopoly. An oligopoly is a market structure where a small number of companies compete and have significant control and influence over that market. A good example would be Pepsi and Coke. Pepsi and Coke are such dominant players in the soft drink market that it makes it challenging for other companies to get established within that market, but there is multiple companies competing. Question number 3. What term describes the rise in the cost of living over a period of time? A, surplus, B, price ceiling, C, deflation, D, inflation. The answer is D, inflation. Inflation is the increase of the cost of living over a period of time, generally applied to a broad basket of goods and services. An example of a metric that tracks inflation is the Consumer Price Index, which is calculated by the U.S. Bureau of Labor Statistics. CPI will report inflation over a broad basket of market goods. Question number 4. What describes the amount of goods and services that people are willing to sell at a specified price at a point in time? A, quantity supplied, B, surplus, C, discounts, D, quantity demanded. The answer is A, quantity supplied. Quantity supplied is the amount of goods and services that people are willing to sell at a specified price at a point in time. In other words, this is what suppliers are bringing to the marketplace. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. Okay, let's move on to question number 5. Question number 5. A minimum wage law is an example of A, a price floor, B, supply and demand, C, a price ceiling, or D, market equilibrium. The answer is A, a price floor. A price floor is a law or enforced price control that sets the minimum price a good or service can be sold for. This is the lowest price set usually by a government that anything can be sold for. In our example here, this is the lowest amount you're allowed to pay an employee. Question number 6. What market structure describes one company that controls the market and prevents new companies from competing in the market? A, monopoly, B, oligopoly, C, monopolistic competition, D, perfect competition. The answer is A, monopoly. A monopoly is a market structure where one company controls and influences the entire market. They have price controls. They have no competition. In the United States, if you're determined to be a monopoly, the government can break up your company. Question number 7. A government mandate to restrict the price of rent in a certain area would be considered A, price floor, B, supply and demand, C, price ceiling, D, market equilibrium. The answer would be C, price ceiling. A price ceiling is a price control that sets the maximum price a seller can charge for a good or service. This will usually be legislation or coming from a government agency that's enforcing a price ceiling. This is the opposite of a price floor. Question number 8. What is it called when quantity supplied equals quantity demanded? A, surplus, B, deficit, C, market equilibrium, D, elasticity. The answer is C, market equilibrium. Market equilibrium is when quantity supplied, what is brought to the market, equals quantity demanded, what is demanded out of the marketplace. This is when you are living in economic harmony. Question number 9. What describes stagflation? A, high inflation and unemployment. B, high inflation and low unemployment. C, low inflation and high unemployment. Low inflation and low unemployment. The answer is A, high inflation and high unemployment. Stagflation is when inflation is high and unemployment is high. This is not a great scenario to be in. This broke the Phillips curve model in the 1970s when it was believed that unemployment was a trade-off for inflation. Stagflation is not the economy that you want to live in. And our last question, question 10. When quantity supplied to the market falls and quantity demanded remains the same, prices will A, decrease, B, increase, C, remain the same, D, need to be discounted. The answer is B, increase. When the quantity supplied to the market decreases while the quantity demand remains the same, this will cause a shortage. You have the same amount of people that want the same amount of goods, but you do not have the same amount of supply or same amount of goods. So the result is prices will rise. Question number 1. What does AGI stand for on a 1040 U.S. individual income tax return? A, adjusted gains income. B, all gross income. C, adjusted gross income. D, all gains included. The answer is C, adjusted gross income. Adjusted gross income, AGI, is defined as total gross income less deductions, your adjustments to your income that you're eligible to take on your 1040, ultimately getting down to almost to the point where you're going to calculate taxable income. Question number 2. What IRS tax form will an independent contractor receive for providing professional services for a client? A, W-2, B, 1099 NEC, C, K-1, D, 1098. The answer is B, 1099 NEC, which stands for non-employee compensation. A IRS 1099 NEC is a tax document that you'll receive if you earn non-employee compensation. You're not a W-2 employee of the company that you provided services for. You've been hired as a contractor, and you will receive this at the end of each year if a business or person has paid you. Question number 3. What tax return will a U.S. partnership file? A, 1065, B, 1066, C, 1099-P, D, 1040-P. The answer is A, 1065. A partnership is a legal entity that has multiple individuals that own that entity. A partnership does not pay tax on its income, but it passes through any profits and losses to its partners via a K-1, which they report on their 1040. Question number 4. If you have ownership in a pass-through entity such as a S corporation, the owner will receive what tax form each year? A, 1099-K, B, W-4, C, K-1, or D, 1099-S. The answer is C, a K-1. An S corporation is a pass-through entity, and a Schedule K-1 from an S corporation, a partnership, or an LLC is going to report your share of income, deductions, credits from your ownership, in this particular example, an S corporation, and you're going to take this K-1 and you're going to take the information on it and report that on your 1040, and that's where the tax gets paid. If you've gotten any value out of this tax quiz so far, please smash that like button and consider subscribing. All right, let's continue with our tax quiz. We got 6 more questions to go through. Question number 5. If you own rental real estate, you generally will file what schedule on your 1040? A, Schedule D, B, Schedule E, C, Schedule A, D, Schedule F. The answer is B, Schedule E. If you own rental real estate and you have income from renting out the property and related expenses to the rental real estate, you're going to file Schedule E to reflect the rents you received from any tenants and any expenses related to maintaining, depreciating, or any costs related to the rental real estate. Question number 6. A Roth IRA will generally provide what tax benefit? A, a pre-tax payroll deduction, B, tax deduction on your 1040 for IRA contributions, C, no penalties for early withdrawal on earnings, or D, tax-free distributions once you reach the age of 59 and a half or older. The answer is D, tax-free distributions at age 59 and a half or older. Roth IRAs let you make after-tax contributions that can grow tax-free within the IRA. The beauty of a Roth IRA, as the income and the investments grow over time, when you withdraw after 59 and a half, assuming you've held the Roth IRA for 5 years, all those distributions are tax-free. Question number 7. If you are self-employed, what schedule do you file on your 1040 to report your self-employed income? A, Schedule F, B, Schedule A, C, Schedule C, D, Schedule E. The answer is C, Schedule C. If you are self-employed, independent contractor, running your own small business, even a single member LLC, you're going to use Schedule C to report your revenue, your sales, and also report your business expenses, ultimately getting to your Schedule C, your self-employed net income, which will end up being taxable. Question number 8. Which one of these is not a tax filing status? A, single, B, married, C, retired, or D, head of household? The answer is C, retired. Retired is not a filing status recognized by the IRS. There are 5 filing statuses that you can use to file your tax return. You can either file single, married filing jointly, married filing separately, head of household, and then qualifying widow with dependent child. Now, each one of these has a different tax situation. Sometimes when you file married filing separately, you won't get certain tax deductions. So you got to be really careful and thoughtful when selecting your filing status. Question number 9. Which one of these entities is not a pass-through entity? A, single member LLC, B, S corporation, C, C corporation, or D, partnership? The answer is C, a C corporation. A C corporation will file its own tax return and it will also pay its own taxes. Unlike a pass-through entity that passes on the income and expenses to its owner via a K-1, a C corporation that files an 1120 pays its own taxes. Question number 10. When filing your 1040 tax return, what gives you the greatest tax benefit? A, interest income, B, a tax deduction, C, a tax credit, or D, modified tax accrual adjustment? The answer is C, a tax credit. A tax credit is a dollar-for-dollar reduction of taxes owed. Unlike a tax deduction will lower your taxable income, which is less impactful than a tax credit. For example, if you owe $10,000 in taxes and you have a $5,000 tax credit, you only owe $5,000 in taxes. All right, that is our tax quiz. Let me know in the comment sections how many you got correct after taking this quiz. And I hope this was helpful. I hope you learned something from this. Have a good rest of the day, and I will see you in the next video.
Yeah.